If you're planning to buy a home in Newark or anywhere in New Jersey and you're worried your credit score might stop you from getting approved, this video could save you months of frustration. Because the biggest risk many homeowners face right now is waiting to apply because they believe credit myths that simply are not true. Today, I'm going to explain the real rules lenders use when evaluating credit scores for mortgages. We're going to cover what credit score actually matters for mortgage approval, how fast credit scores can realistically improve, why paying off debt can sometimes lower your credit score, and how credit works when two people apply for a mortgage together. By the end of this video, you'll understand how credit actually works in the mortgage world. Let's break it down. Most people believe there is one single credit score, but that's not actually true. There are dozens of different credit scoring models. For example, the score you see on Credit Karma, credit card apps, bank websites is usually not the same score lenders use for mortgages. Mortgage lenders use something called FICO, and those are calculated using three credit bureaus: Experian, Equifax, and TransUnion. Then the lender uses the middle score, not the highest and not the average. So if your score looks like this: Experian 701, Equifax 684, and TransUnion 720, the score used for mortgage approval would be 701. This is one of the biggest misunderstandings buyers have. Now let's talk about the scores that actually matter for mortgages. In general, FHA loans can go as low as 580 credit score. Some lenders may go slightly lower, but 580 is the standard guideline. Conventional loans typically start around 620 credit score, but the real pricing improvements happen at certain tiers. For example, 620 to 639, 640 to 659, 660 to 679, 680 to 699, 700 to 719, 720 to 739. Once borrowers reach around 740, the price improvements usually level off, which means a 740 score and an 800 score often receive very similar mortgage pricing. So chasing an 800 score usually does not improve your mortgage rate. Another huge myth is that improving credit takes years. In reality, some of the biggest improvements can happen within 30 to 60 days, or even faster. Why? Because credit scores react quickly to certain changes. For example, credit utilization. If someone has a credit card with a $10,000 limit and a $9,000 balance, their utilization is 90%, which can hurt their score. If they pay that balance down to $2,000, their utilization drops to 20%. That single move can increase a score 40 to 80 points in many cases. The reason is simple. Credit scoring models heavily reward low revolving balances. So strategic debt paydowns can sometimes improve scores surprisingly fast. Now here's something that surprises many buyers. Sometimes paying off debt can actually lower credit score temporarily. Let me explain why. Credit score modeling rewards active credit history. If someone pays off a loan and closes the account, they may lose account age, credit mix, active trade lines. For example, let's say someone has two credit cards and one auto loan. If they pay off the auto loan and it closes, their credit mix changes from 3 accounts to 2 accounts. That can cause a temporary drop in score. This is one reason why it's important to talk with a mortgage professional before paying off accounts right before applying. Because sometimes the smartest strategy is different than what people expect. Now let's talk about how credit works when two people apply together. Many buyers assume the lender will use the higher score, but that's not how mortgage underwriting works. When two borrowers apply together, the lender uses the lower of the middle score. Example, borrower 1 scores are 740, 735, and 720. That middle score is 735. Borrower 2 scores 690, 675, and 660. Their middle score is 675. The score used for the mortgage would be 675. That number determines loan approval, mortgage insurance costs, interest rate pricing, which means sometimes borrowers qualify better by applying individually rather than jointly. This depends on income and debt ratios, but it's something lenders evaluate during pre-approval. Before applying for a mortgage, buyers often make these mistakes: opening new credit cards, financing furniture or appliances, maxing out credit cards, missing payments, Even something simple like financing a $2,000 couch can affect your debt to income ratios, and that can impact your mortgage approval. This is why lenders usually recommend keeping finances stable during the home buying process. So let's recap the biggest credit myths. Your credit score is not just one number. Mortgage lenders use the middle score from 3 bureaus. Scores can sometimes improve much faster than people think. Paying off debt can occasionally lower scores temporarily. And when 2 people apply together, the lower middle score is what matters most. Understanding these rules can save buyers months of waiting and frustration. If you're planning to buy a home in New Jersey and you want to know what your real mortgage credit score looks like, what you actually qualify for today, or how to improve your score quickly, check the link in the description. I'll review your scenario personally and walk you through the numbers. No pressure, just real mortgage guidance. If you found this helpful, like the video, subscribe to the channel. And next week, I'm breaking down how lenders actually calculate debt-to-income ratios for mortgage approval. Trust me, that's another topic most buyers completely misunderstand.